Hi, everyone. I want to welcome everyone back to our Macro Matters podcast. It's been about, 6 months or so, I think, since we did the last Macro Matters. We had a little bit of a reprieve there, and we've had some changeover in the team that's here to talk about things. And so I want to welcome the team that's going to be talking about this with me. So first, I want to welcome Monique Thanos, who's on the CFA Society Chicago with us, and is I know you're in the Women's Network, Monique. I know you're a quantitative finance expert, but tell us a little bit what you do at the CFA Society.
So at CFA, I've been volunteering in the committees. I used to work with the humans committees and also in the educational committee. So helping out with the organizing panels, especially now that I'm in crypto. I used to be in normal traditional equities. Now I'm in crypto. And so there's I add some flavor there to the panels.
Awesome. Well, welcome aboard. Thank you for joining us. And as always,
welcome aboard.
I have my colleague from University of Illinois Geese College of Business, Tony Zhang. Tony, welcome back. Glad to see you again.
Yeah, so glad to see you, Rich, and so glad to see Monique on board. So it has been over 6 months before we can have another time to actually come back in. I think over the past 6 months, so many things, exciting things, and also bad things have happened. So I think it's a great moment for us to reflect on some of the key topics.
Yeah, there's a lot of things that have changed in those last 6 months for sure. And I think we're going to hit on a few of those. But maybe before kind of going in, it's really the big thing that's, as you know, with Macro Matters, we try to cover the current topics and try to turn it around very quickly. And the biggest topics of late have been really something we've been talking about for almost 2 years, is a lot of the inflation data. The strength of the economy and the inflation data seems to be a big subject for debate. I don't know if, Tony, maybe you want to jump in first and tell us what you're seeing on your end from all this economic data.
Well, apparently, when talking about the macroeconomic, one of the biggest issues right now is focusing on the CPI data, right? The consumer price index inflation. So with the latest report that we have seen that actual headlines, also the core CPI have a month-over-month increase about 0.5%, but on annual basis, this is roughly about 6.4%. This is versus the expected headline month-to-month growth about 0.4%, compounded 6.2% of annual rate. Even though we have seen this CPI rate has been falling a little bit, but it's actually not falling fast enough. I think, Rich, you also have a lot of things to cover, but maybe today's given us this the CPI data, and also we might want to uncover what are the main drivers just behind this, what I should say, stubborn CPI data. I think this will be a lot of interesting things for us to discuss today.
Absolutely. So maybe, I don't know, maybe we'll just jump in there real fast and take a look at it. I'm going to share my slides. So those that are watching on YouTube can certainly see the slides. And for those on the podcast, we'll talk about these. But here I show you what Tony was talking about, the CPI data. We have the CPI line in white, which is coming off a peak of almost 10%, and it's down to 6.4, but that's still, as we know, well above the Fed's 2% target, right? And we also got PPI last week, and PPI kind of still is also coming in around 6%. And this chart here, we see that, I overlay also the 10-year nominal U.S. Treasury yields, as well as the five-year forward inflation expectations. And we can see that, obviously they're all very related to each other, right? PPI, inflation, whether it be CPI or PPI, is going to have a strong impact on people's inflation expectations and on nominal yields. And that's certainly something that the market's going to have to contend with, that maybe inflation is not coming down as quickly as we thought.
Definitely, of course. Well, now, because the CPI is one of the biggest issue, or one of the major factors from the Federal Reserve perspective in determining their rate policy, because the interest rate hike had over the past 6 months have given enormous pressures over the equity market. lot, especially from last year's, we can tell that even the S&P 500 fall down more than 20%, roughly 20%. But the interest rate hike path from this year actually has been discussed in a different way over the past few weeks. That we have already seen that the tone or the narrative about the CPI has changed dramatically from the high CPI to more of like a fast decline in the CPI data, which actually might given some of the incentives for Federal Reserve to pause the interest rate hike, which actually stimulate the overall stock market, especially the stock with long duration. I think last year we have been discussing about this, like the performance for those kind of stock with long duration in an interest rate hiking environment, right? Especially a very typical case will be the ARK ETF by the Cathy Wood. This is very reputational. Last year have been falling significantly, but starting in January, the narrative has changed dramatically. Now, it's people would think that after the interest rate hike in February, that might be possible after another hike in March meeting, which will be on the March 22nd. I think a lot of people, especially the investor, would keep a very close eye on that. Would Federal Reserve pause the interest rate hike from that point? What's your thought, Rich and Monique, over that?
I don't know, Monique, what are you thinking right now?
Yeah, so I was thinking, yeah, I agree with you that there's a lot of talking about even if potentially by the end of the year, the pause and everything. But also like this week, there some people coming back and talking about actually increasing 50 pips for the next one, just because the numbers came so hot. So they were like, there's mixed signals here, right? Coming from the economic data. But also one thing that I was going to bring it up, it's the fact that there's also like seasonality adjustments that sometimes January data, sometimes it's not like the most quote data that will follow. It's just a one data point, right? So I feel that the Fed will probably will follow more like a trend, check what's happening towards multiple months. And definitely for the next month, it's going to be a critical month, because now without the seasonality part, they're probably going to have more data points to see where they're going to go. So we'll see. Hopefully not 50 bits, hopefully just 25, but we'll see.
Yeah, I think you're right, Monique. I mean, with this inflation that Tony was mentioning has been a lot more persistent than I think the FOMC really was hoping for. And I think the market hasn't fully adjusted to where the FOMC is. I always have a few charts. And so there's a couple more I wanted to show everybody here. So let me see, go to the slideshow here. So this is the how many interest rates are being priced into the Fed funds futures curve. And if you look at this now, this is as of today, you can see now that there's actually through July, there's almost 3 hikes priced in. So 325 basis point hikes. Now, I think the market would be very surprised if, as you said, Monique, if we got 50 basis points at any one of these meetings, but it does suggest maybe higher for longer. And that's something that's, is slowly is a little bit different than where we were at the start of the year. But you still see towards the end of the year that there's some cuts that are priced into the futures curve there. And so if you go to the next one, this just shows you the Fed funds futures more visually across the entire curve. And you can see at the very top is what the Fed funds futures were back in a month ago on January 20th. And then we had what was a week ago, and then today. And you can see this across the federal fund futures curve, that the flattening of this curve is showing you that the market is slowly but surely pricing in a little bit more hawkishness from the Fed because of this data that's coming in increasingly hotter than everyone expected. And then if I just show you the last one here, this is comparing those same Fed funds futures to the FOMC's dot plots. Now, that's the other interesting thing we're going to get in March is we're going to get a new set of the dot plots from the FOMC. And so then there's going to be much speculation about what will that look like and how different is the market from where the FOMC is. You can see that even with this flattening of the curve, taking out some cuts, pricing in more hikes, the market still isn't where the FOMC is. And so I think there's some, I think the market still has to catch up with the hawkishness that Jay Powell and the Fed has. And I think that's going to cause for a little bit more difficulty, perhaps, as we look into the price action here for the next month or so.
Rich, I think you definitely raise a great point right over here. Like, given what you have shown me, like right now is in March 22nd meeting, I think market only pricing that FOMC might only hike the interest rate for another 25 basis points. However, this it's also shown that maybe in May 3rd, another meeting, that there might be some chance they might hike additional 25 basis points before July, so which will be pointing to the June 14 meeting. This is to be some 50% of chance that one final additional 25 basis point could be added over to market. And this is a very great shown by the data. However, the market, especially the equity market, remains so resilient at this moment because they define all of they are defining all the force to drag down. The people have been talking about the recession, as what we have discussed later last year, that we are pretty much assured that there might be a recession, which actually might pointing to might dragging down the stock market as well. However, the resilience of the stock market here actually is pointing to a different narrative, that high interest rate, even though pointed by maybe adding the pressure for the discount factor, is illustrated in the traditional DCF model. A high interest rate might actually it might be related to a higher discount rate. However, this is not a point, or some at least from the market's logic here, is that the corporate's earning from their operational cash flows might remain robust given the current strong U.S. economy. So this is, I think, this overall the market is it's really hesitated, at least at this moment, really hesitated to respond to this like a higher probability that Federal Reserve might have to hike additional 75 basis points from now on. This is the only explanation right over here. But I agree with you that if anything goes wrong for the next quarter, in the Q2, that market had to adjust it to the current valuation, or at least the current valuation mechanisms for this, because market really set a high tone from a recession to soft landing to even right now close recently the no landing scenario, right? What do you think about just to no landing?
Yeah, I'm not a betting man, Tony, but in the last 14 rate hike cycles from the FOMC, we've had 3 soft landings and 11 hard landings, and we've had 0 no landings. So I think I'm going to suggest that there probably is a recession in our future, whether we want to agree with it or not. And kind of building on your point a little bit, I was struck at the last press conference when Chairman Powell constantly referred to the need for more hikes, plural, not singular. And so really kind of suggesting that, there's definitely more than one hike in his mind, and higher for longer is that idea that keeps coming back. And, I think the market was surprised for several years at how low the Fed kept interest rates when it was really worried about deflation. Well, now that the market's really worried about inflation, I wonder if the market might be surprised at how high the Fed can stay for how long. And that might be an interesting thing. But there's something you brought up before. I want to get Monique's view on this. And that was the idea of long duration, and how long duration assets of all types struggle when we're in a market where the cost of capital is going up. And Monique, unique perspective, because you've looked at lots of different long duration but assets from a quant equity standpoint, from a crypto standpoint. So when you're building your models and you're thinking about this type of thing, how are you factoring in like those higher cost of capitals, or how much are you thinking about that?
Actually, right now I'm in crypto, so it's a little bit different. So
Yeah.
the way the quant models are very different. But there's one point that I want to talk about that Tony mentioned about the soft landing, hard landing. And I know most likely, usually people just think about, okay, the Fed's going to make a mistake. We're going to get into a recession, hard landing, whatever. But we came from a very different period because of COVID. So a lot of things are very different, right? Now, there's a chance of we end up not getting a hard landing for sure. But there is actually a chance of a soft landing just because there's so many different aspects going on. Now, I agree. At the same time, I agree that the Fed is kind of like sticky with the 2% inflation. I don't know if a few days ago, someone was asking Jay Powell, and he was like, no, it's going to be a 2%, 2%. And sometimes I'm wondering if he just says 2% so the market gets prepared, or he actually going to be stick with the 2% mandate. So I don't know what you guys thought about it. I don't know. It sounds very like very enforcing the 2% may be prone to make a mistake just because of the stickiness of the 2%. I don't know. That's how I feel. But
my personal, my view would be, I don't think Jay Powell wants to be known as the Fed, the Fed chairperson that's lost control of price stability. And so I think that he would rather err on the side of, even going below 2%, and certainly doesn't want to stop above 2%, because the history suggests that if the Fed pauses when it's above its target, there is a chance for a reacceleration of inflation. True. And so that's the one thing where I think the soft landing if it does show up and it's in the strength of data, which we're seeing, frankly, in the jobs data, the jobless claims, the retail sales, that's just going to mean the Fed's going to stay that much more involved because they're worried about a reacceleration of inflation. And I think that's what kind of gives a lot of trouble for the higher growth assets going forward personally. But like Tony said, the market's very, very resilient right now. And so you have to respect that. What do you think?
I agree. Yeah, go ahead.
I agree. Yeah, I agree with both of your thought, and especially I want to add a comment to what Richard just say. In recent FOMC meeting, apparently Chairman Powell, apparently he pointed to one key thing. What he was referring to, not generic like inflation, but what he referring to was called a core non-shelter service inflation, right? So just a core non-shelter service inflation is basically a measure of the rate of price change of goods and services that are not related to housing, right? Such as transportation, medical care, and foods. It's actually just used to measure the cost of living for households that do not incur housing costs. It's like, as long as I don't own a house, I don't want to buy a house, and any expense other than buying a house will be something that he might be concerned of. So he actually shifted the focus a little bit to more of this. But from what we have known, that actually the core non-shelter index or service encompass a very wide array of tasks where we are seeing the persistent labor shortage and demands that are leading to this inflation. The inflation is very stubborn just because in the wide array of the sectors where we are actually seeing a huge labor shortage. This is some evident in such area like in dental's office, hospitality, right? Even also leisure service. This is wide range. I think it's one of the contributing factors that why the Chair Powell has repeatedly warned that bringing the inflation down across such a wide array of category would take time. But the market just is seeing apparently two different ways. Now this is vibrating. Stock market is so resilient, and Rich described it. description. I think this is had multiple forces. So labor shortage apparently is also one driving force behind this. Also another is maybe the wage growth. The wage, we see from the data here, it shows the wage growth remain to be very resilient as well from both the non-farm payroll, including both job switchers and job stayers, right? So what's your thought about in that two perspective, Monique and Rich?
Yeah, I agree that the labor market is still like a full employment, and I think that's one of the data points that they analyzed too. Of course, ideally, we can reduce this inflation without anybody have to lose their jobs. Although now recently there's been a lot of layoffs announcements, so that's why I think the next month data will be very, very important, because it takes time, right, to kick in all the layoffs and things like that. And also the housing. I mean, I guess housing is also like kind of like the last tail of what's going to happen. It's still to come to see. So I think that waiting a couple months, by June, we will have a way better feeling of what we're going to be like in terms of labor market and housing, if you're actually going to get in a depression, sorry, not depression, a recession or not. Please, we're not there.
Tony, it's interesting because I think, to me, inflation isn't a number, it's a mindset. And it's the same thing with deflation, isn't not a number, but a mindset. And the Fed, through its communication strategy, really wants to prevent that mindset from becoming too strong in consumers' minds, because I think you're absolutely right. With the strong labor market, and as we see, real wages are still not going up. So that most consumers' wages are not keeping up with inflation, even though the labor market is so strong. And I think the Fed does have a worry that that's going to start to come in more and more discussions, which is going to add some stickiness or permanence to these inflation numbers. And the interesting thing, and when you talk about the layoffs we've seen, the couple of things I would point out that we've seen a lot of layoffs, especially in the high margin kind of tech and investment banking industries. But those people must be getting jobs right away, because you're not seeing anything show up in the jobless claims data, because that data continues to be good. And we see with the job openings and labor turnover data, there's still 11 million open jobs. Now, there's a big skills mismatch, right? Because a lot of those jobs are in leisure and hospitality, hotels, gaming, things of that nature, that if you're coding at Google, you're not going to go over and start working at that. So there is a skills mismatch. But I think that idea that we're still that short of people in some of those key industries lead me to think that we could have an economy that I've been kind of joking and referring to it as a job full recession, because if you guys remember, post the financial crisis, we had a jobless recovery. The economic recovery, economic data improved, but people weren't getting hired the way everyone thought. I wonder now if the economic data get bad, but people aren't going to get fired in a lot of these key industries. I don't know.
Yeah, I think that's why.
Definitely. So go ahead, Monique.
I was just going to say, that's why it's key to see for the next couple months or so what's going to happen, because the numbers will be very, very important in now that's coming all the way to kind of June, and that will set the tone for the second semester. So for the year, but go ahead, Tony.
Yeah. So what's happening right now in job market apparently is contrary to what had happened in year 2008 and year 2000, where we actually see the economy and the job market actually was moving into two different directions. Right here now, people has no actually fear of losing their job. Especially right now, this can be corroborated by other data from, for instance, like the office occupation rate. Something like people hasn't really gone back to the office yet. So which means even though some of the employers, such as Amazon, actually has requested all of the employees going back to the office, but now here this is not a case. So employee actually hasn't still retaining some of the bargaining powers versus their employers, right? By not fearing of losing job at all. as Rich just pointed out, now there are actually 2 times of the job opening than just like the number of the unemployment people. So that actually indicated that even for those kind of high skilled workers who just got laid off from well-known tech companies can find job easily, and it's very quickly. So sometimes that's why it hasn't been reflected into the data. That means they got job right away. So this actually would give us support that the inflation actually will remain strong for quite a while, actually longer than what the market has projected at this moment. That's why, well, lots of investors has already jumped back into the growth stock with some hope or anticipation that Federal Reserve might actually pause the interest rate hike faster than what right now the market had anticipated. They might even cut the rate at the end of the year based on some of the narratives, right? Which I tend out to be almost this could be a very small probability event if it does happen, which in my opinion might not be the case.
Tony, I completely agree. And I would just share one last picture with you guys and see what you think of this one. So this one right here, and for those that are listening to this, what I'm showing is in the purple line you can see there, it's the Fed funds future. I'm looking at the 9th contract out just to try to give a little bit of distance. And then the other 2 lines I have, the blue line is the outperformance of NASDAQ stocks versus S&P 500 stocks. So a bit of a proxy for these high growth tech or biotech type of names, the longer duration, if you will. And then the orange line I put on there just for Monique, I put on Bitcoin. And so we could look at it and just see that as the expectation for Fed funds futures is going down, so more rate hikes being priced in. For the last year, that's had a very negative impact on these long duration assets like crypto and like high growth equities. And if this inflation stays persistently high, as you're kind of talking about, and the Fed starts to be even more hawkish, maybe not 50 basis points in March, Monique, but maybe there's a discussion that even after 25 basis points, they need to be more hawkish, or maybe the dot plots will suggest more hawkishness. I wonder how long these long duration high growth assets can stay elevated as they've had been for most of 2023.
So I would think, like, if I'm thinking in equities, because I think crypto is a little bit different, but if I'm thinking in equities, there is a little bit of a challenge right now going on. But instead of thinking like growth stocks, only growth stocks and growth versus value type of thing, I would think more stocks like GARP oriented, like more growth at a reasonable price, quality, like type of stocks. That would be something that would be more resilient in this environment. That's my take on that. I don't know what you guys think about it, because I know there's a lot of people talking about growth versus values right now, but in my experience, GARP, it's high quality GARP names are the ones that kind of not going to be as affected as by the environment right now. That is my take. I mean, growth, but as long as it's a reasonable price, yeah.
Okay, Tony, I'm going to give you the last word because we're kind of coming up against our time limit here. So I'll give you the last word. What do you think?
Yeah, apparently, well, from academic point of view, that investors actually tend to actually create a more alpha, larger return by investing into the high quality stock. But this is apparently it's not a case over the past 1.5 months, right? Given what had happened in the crypto space with the scandal of FTX, we continue to see the money or the capital inflow into the crypto space. That's why we were so surprised to see that the Bitcoin price and Ethereum price appreciated dramatically, significantly over the just past 6 weeks. This happened simultaneously with the long duration stock. This is when the growth stock actually outperforming the value stock again. Now, under the umbrella, we can maybe disintegrate slightly more. the best performing sectors included consumer discretionary and consumer communication service, as what you have shown just now in the slides. Now, consumer discretionary communication service, even though people continue to believe that in consumer discretionary, it might be the Amazon and Tesla who contribute to the huge gain those particular sector, right? Tesla has appreciated more than 70% within such a short amount of time. Now, this is actually might not be a sustainable event. However, in communication service, we continue to see the big cap like Google appreciate significantly. So even though people might be discussing that the overall Google's ongoing revenue might be disrupted by the introduction of the Chat GPT and AIGC, a new revolutionary technology things, right? Initially, we were thinking about maybe having some kind of discussion, but because of time limit, we don't have time. We can maybe save this for next round. But given all this have happened, is the large tech continue to perform significantly, outperform S&P dramatically. This is not a complete story. If we actually apply the equal weighted mechanism of the S&P 500, we find those kind of even a small stock in smaller tech actually are doing much better things. I think all of these things to show that the market participants, especially one of the major components of the market participants, has really fully discounted the potential risk of that Federal Reserve might hike interest rate, or at least it will hold the interest rates longer. This could be one of the major risks for the market right now. I think this, as what Richie continues to suggest, we should remain vigilant given what has happened and what the reality is, right? We definitely are seeing a huge divergence right here, right now.
Absolutely. Well said, Tony. Well, Monique and Tony, thank you for joining me. Looking forward to more macro matters discussions. And so for all the listeners that, we will be doing these on a bi-weekly basis. And so we will see you again in 2 weeks to talk about whatever is the most current topic of that time. So I look forward to seeing you guys in 2 weeks.
Perfect.
Yeah,
Thank
look
you,
forward to
Thanks,
the discussion. Thank you, Rich. Thank you, Richard. Thank you, Monique. I think AIGC could be a next good topic to discuss.